It is 11:47 a.m. on a Tuesday in March. You are sitting in your car in the parking lot of a Home Depot in Dayton, Ohio. You are not buying anything. You have been sitting here for 18 minutes with the engine off, staring at a notification on your phone that you have read 14 times and still do not understand. Your 401k is down 23% from 3 months ago. Your home, which Zillow called $412,000 in January, just got reassessed by the county at $367,000. That is a $45,000 paper loss in 60 days. Your bank just sent a push notification. We noticed a change in your spending patterns. Would you like to review your account? You do not remember changing your spending patterns? You are a 38-year-old project manager. You make $87,000 a year. You have a mortgage you refinanced to 2.9% in 2021. You have an emergency fund with 3 months of expenses. You did everything right. So you sit in the parking lot and you try to figure out which of these 3 things is the thing that means something. The answer is all 3 of them mean something, and none of them mean what you think. Not yet. In 2007, the first person who noticed something was wrong was not a banker. It was a statistician named Michael Burry, who read 1,000 mortgage bond prospectuses and found that the loans inside them were deteriorating faster than anyone admitted. He started betting against housing in 2005. Everyone told him he was crazy. In 2008, he made $720 million for his investors. In 2000, it was a 26-year-old who noticed that every internet company with no revenue was trading like it had a product. He shorted the NASDAQ. He's right. The NASDAQ lost 78% in less than 2 years. The names change, the mechanics do not, and the mechanics are saying something right now. Level 1. The person who thinks IT is fine, your name is Marcus. You live in a suburb of Phoenix. You are 41. You work in supply chain logistics. Your company announced layoffs last month to 8% of the workforce, and your team lost to people. You survived. Your boss handed you a $3,000 bonus check. You spent $600 of it on a weekend in Sedona with your wife. You put the rest in your brokerage account. You feel good. Your mortgage is 2.9%. Your credit score is 764. This is the most dangerous place to be. Not because you were wrong. You were not wrong. Your job is stable. Your mortgage is cheap. These things are real. The danger is that you have built your sense of safety on 3 things that are all sensitive to the same variable: the cost of money. Your mortgage exists because rates were 2.9%. If you refinance today, the rate would be 6.5% to 7.8%. The same house would cost you an additional $2,000 per month. That is not a hardship. That is a different life. Your job exists because someone has to manage supply chains. But your company carries $4.2 billion in debt at 4.1%. When that debt rolls over, and it rolls over every quarter, the new rate will be 5.6% to 8.1%. At 8.1%, the annual interest expense doubles from $172 million to $340 million. That is the number that decides whether your department exists in 2027. Your brokerage account exists because the S&P 500 went up for 14 years. The index is priced for earnings growth that assumes rates stay below 4.5%. At 6%, the fair value PE drops from 22 to 16. That is a 27% repricing of every stock you own. Marcus has done everything right. Marcus is not stupid. Marcus is simply operating in a world where the cost of money has been free for 15 years, has now started to become expensive, and the repricing of everything priced during the free era has not finished happening yet. The rule. The first rule. The people who feel safest are usually the ones with the most to reprice. Level 2. The person who sees it but cannot move 3 states away. In a cubicle on the 14th floor of a bank in Chicago, there is a woman named Denise, who works in commercial real estate lending. She's been at the bank for 11 years. She knows which developers are honest and which ones inflate their rent rolls. She has seen 3 credit cycles minus 2008, 2020, and the one happening right now. In 2008, she was 24. She watched her bank stop lending entirely. She watched the loan officers who had pushed the hardest get laid off first. She learned that the people who believed housing prices could not fall nationally were not evil. They were just wrong. And being wrong in banking is expensive. In 2020, she watched the opposite. The Fed cut rates to 0. The government sent checks. Commercial real estate went into free fall. The banks did not collapse because the government guaranteed everything. The losses were socialized. The gains had already been privatized. Denise learned that in a true emergency, the rules changed for everyone at once. Now, in 2026, she is watching a third thing. Commercial real estate loans are worth $4.1 trillion in the United States. Of those, $1 trillion mature between now and 2027. Those loans were written when cap rates were 5.5% to 6.5%. They were financed at 3.5% to 4.5%. Today, the same properties generate the same rent. But to refinance them at current rates, the new payment is 38% to 55% higher. The property does not generate enough income to cover it. The bank cannot lend the full amount. The borrower cannot pay the gap. So the property goes into default. This is not a prediction. This is arithmetic. And Denise knows from 11 years in the bank that this arithmetic has a consequence nobody in a parking lot in Dayton is thinking about. When a $40 million office building in suburban Dallas goes into default, the loss does not stay at the bank that lent the money. The loan was packaged into a CMB's, a commercial mortgage-backed security, and sold to investors who bought it because it had an AA rating. Those investors include pension funds, insurance companies, your 401k if you have a target date fund. The chain is longer than anyone in a parking lot imagines. And the chain is only as strong as its weakest refinancing. Denise has a spreadsheet. She updates it every Monday, tracks every commercial real estate loan in her bank's portfolio that matures in the next 18 months. The current rate and the probability, her probability, not the bank's, that the borrower can refinance. Her spreadsheet has 237 rows. 94 are yellow, 41 are red. She has not told anyone about the spreadsheet. She knows what happened to the people who talked in 2008. The rule. The second rule. The people who see it coming are often the ones with the most to lose by saying so. Level 3. The person who made different choices you have. A friend. His name is Kyle. You have not talked to him in 2 years. You remember Kyle? Because 12 years ago, he was the person at the office who did everything differently. When everyone else was leasing BMW 3 Series cars on 72-month terms, Kyle drove a 10-year-old Honda Civic. When everyone else was putting 100% of their savings into their 401k, Kyle had 18 months of expenses in cash and treasury bills. When everyone else told their spouses that real estate was the best investment they would ever make, Kyle told his wife that the best investment was the one you could sell in 3 days without losing 20%. Everyone thought Kyle was paranoid. His own brother told him at Thanksgiving in 2019 that he was wasting his life being afraid of something that would never happen. In March of 2020, Kyle's portfolio dropped 28%. Everyone else has dropped the same. But Kyle had 18 months of expenses in cash. He did not have to sell anything. He watched 3 colleagues panic sell at the bottom because they had been using their 401k as an emergency fund. He watched one of them retire early on much worse terms than planned. In 2022, when rates started rising, Kyle's fixed rate mortgage stayed at 3.1%. His LOC taken out in 2022 renovate the kitchen went from 3.7% to 8.4%. His payment went from $287 to $721. He cried in his car that day, but he had the cash. He paid it off. He was not trapped. Today, Kyle has $340,000 in treasury bills earning 4.8%. He has a house with no mortgage. He has a job he could walk away from. Still drives a Honda Civic. It is a 2019 now. You run into him by accident. You're both at a pharmacy, reaching for the same brand of toilet paper. You recognize him. He recognizes you. You look good, you say. I feel good, he says. Then, after a pause, how are you? You tell him. Tell him about the parking lot. You tell him about the 401k. You tell him you do not know what any of it means. He listens. He does not say, I told you so. When you finish, says the people who are okay right now are not the ones who predicted this. They are the ones who built their lives so that prediction didn't matter. That sentence is the whole point of this video. The rule. The third rule. The people who survive a crisis best are not the ones who saw it coming. They are the ones who built their lives so it did not have to come for them. what is actually happening, let me stop telling stories for a minute and give you the numbers. The stories are true, but the numbers are why. The Federal Reserve raised rates from 0.25% to 5.5% between March 2022 and July 2023, the fastest tightening in 40 years. The actual effect was broader than inflation. It repriced every financial asset in the economy that had been priced during the zero-rate era. Consumer debt, $17.5 trillion total. $1.1 trillion is credit card debt, averaging 22.8% interest. The percentage of people who can only pay the minimum is at its highest since 2011. The charge-off rate has doubled in 24 months. Commercial real estate, $1 trillion in loans mature by the end of 2027. The average office property is worth 45% less than in 2019. Vacancy rates in major cities are 18% to 26%. The refinancing math does not work for a large percentage of these properties. The banks are not disclosing the full extent because the rules allow them to classify troubled debt restructurings as performing as long as the borrower has not yet missed a payment. The bond market, the 10-year Treasury yield, the single most important number in global finance, has been volatile between 4.0% and 4.9% for 18 months. At 4.5%, the fair value P/E of the S&P 500 is approximately 16 at current levels. A significant percentage of the index is trading at multiples that assume rates stay below 4% for the next decade. If rates stay where they are, the market must either grow into those multiples or reprice them downward. The federal government, running a deficit of $1.8 trillion per year. Interest on the national debt is now the fastest growing category of federal spending, surpassing defense in 2024. The weighted average rate on U.S. debt is 3.2%, but the average maturity is only 6 years. Every year, roughly 17% of the debt rolls over to current market rates at 4.5%. Annual interest expense goes from $870 billion to over $1.2 trillion within 5 years. These are not opinions. These are numbers from the Federal Reserve, the Treasury, the FDIC, and the S&P 500's own filings. You can look them up. The question is not whether these numbers are real. The question is whether they are connected. And the answer is, they are connected by a single variable, the cost of money, and that variable has been going in one direction for 42 months, and the repricing of everything, priced during the opposite era, has not finished. What to do about it? Most videos that use this title tell you to buy gold, or sell everything, or move to a farm. Those are panic responses, and panic is the most expensive emotion in finance. Here's what the data says actually works from the people who have been through this before. 1. Lengthen your time horizon. The single most reliable predictor of financial outcomes in a crisis is not what you buy or sell. It is how long you can afford to wait. The S&P 500 has had 13 corrections of 20% or more since 1950. The average recovery from a 20% decline is 23 months. From 30%, 49 months. From 40%, which happened in 2008 and 2022, 4 and 6 months respectively. The difference between those two 40% declines was not the market, it was the government. In 2020, the Fed and Treasury intervened within 6 weeks. In 2008, they intervened in 18 months. The recovery time tracks the intervention time. You cannot control the government. You can control whether you are forced to sell before the recovery happens. 2. Increase your liquidity runway, the standard. Advice is 3 months of expenses in cash. That advice was written for a world where layoffs lasted 90 days. Today, the average duration of unemployment for a worker earning $60,000 to $100,000 is 5.7 months. For workers over 45, it is 7.2 months. If you have 3 months and lose your job, you have 3 months to find a new one. In a crisis, that is not enough. The people who get through these periods without permanent damage have 9 to 12 months of expenses in liquid assets, treasury bills, money market funds, high-yield savings at current rates. You can earn 4.5% to 5.2% on that cash. It is not a fortune, but it is freedom. 3. Audit your debt for rate sensitivity. Go through every debt you have. For each one, write down the current rate, the remaining balance, the monthly payment. And most importantly, whether the rate is fixed or variable and when it resets. The debts that kill people in a crisis are not the big ones. They're the ones that look small and behave like they are fixed until the day they are not. A HELOC at 3.7% that resets to 8.4% looks like a $287 monthly payment until it looks like a $721 payment. A credit card at 22.8% that you have been paying the minimum on for 2 years looks manageable until you calculate the total cost. 9 years and $2,340 in interest for a $1,200 laptop? The rule. The fourth rule. The thing that destroys you will not look dangerous on the day you signed up for it. It will look like a reasonable number that changes on a schedule you forgot about. 4. Stop measuring your safety by your current income. Your income is a number. That changes when someone else decides to change it. Your job, your bonus, your side hustle, all of it depends on conditions outside your control. Measure your safety by your runway, not your income. If you lost your income tomorrow, how many months of your current life could you fund without selling anything at a loss? If the answer is less than 9 months, that is not a crisis prediction. That is a preparation gap. 5. Pay attention to the people who have been through this, not the influencers who have never managed money through a down cycle. People who have, not the ones who predicted the last one, half of them got lucky. The ones who had money in the market in 2008 and are still here. The ones who built their lives so the next cycle would not require them to be right about the timing. The people who have been through this before do not talk about predicting the next one. They talk about surviving it regardless of when it comes. Back to the parking lot. You have been sitting here for 31 minutes. The sun has moved. The light through your windshield is different, lower, warmer, the kind that makes you notice the dust on your dashboard. Your phone buzzes. It is Alina. She's at the grocery store. She wants to know if you are coming home for lunch. You look at the notifications again. The 401k is still down 23%. The house reassessment is still $45,000 below Zillow. The bank still wants to review your spending patterns. But now you see something you did not see 31 minutes ago. The 401k is down 23% from its peak, but it is still up 62% from 3 years ago. You have not lost money. You have lost gains. There's a difference. The house reassessment is $45,000 below Zillow's estimate, but Zillow's estimate was never a real offer. It was a prediction model.
Oh.
The county's number is also a prediction model, just a different one. Neither is the price you would get if you sold the house tomorrow. You are not selling the house tomorrow. The bank's notification about your spending patterns is not a warning. It is a risk model flagging variance. You are one of 4 million customers being flagged. You put the phone in the cup holder. You start the car, you drive home. On the way, you pass a bank. The same bank. The one that sent you the notification. You think about Denise and her spreadsheet. You think about Marcus and his refinance mortgage. You think about Kyle and his treasury bills and his Honda Civic. You think about the rule. The people who survive a financial crisis are not the ones who predicted it. They're the ones who built their lives so that prediction did not matter. You think about whether your life would survive a crisis. You realize you do not know. Yet, but now you know what to check. You pull into your driveway. Alina's in the passenger seat before you even turn the car off. She never waits in the house anymore. She hands you a cup of coffee. It is still warm. Everything okay? She asks. Yeah, you say. Everything's fine. And for the first time in 31 minutes, you mean it. The get ready checklist if you want to actually get ready, not watch another video about it, but get ready. Here's what to do this week. Day 1, log into every account. You have every bank, every credit card, every loan, every brokerage, every retirement account. Write down the current balance, the interest rate, and the next payment date. Put it all in one spreadsheet. You cannot manage what you have not measured. Day 2, classify every debt as fixed or variable. For every variable rate debt, write down when it next resets and what the reset rate would be at current market rates. Day 3, calculate your real emergency runway, total liquid, assets divided by monthly non-negotiable expenses, housing, food, insurance, minimum payments, utilities. If it is less than 9 months, that is the single most important financial number in your life right now. Day 4, Audit your income sensitivity. If your primary income stopped tomorrow, how many months to replace it? For most people, the honest answer is longer than they think. For people over 45, significantly longer. That gap is your real risk exposure. Day 5. Look at your investment portfolio. Not to sell, to understand. What percentage would drop 30% in a crisis? What would hold steady? You need to know what you have before the next move. Day 6. Build your liquidity ladder. If your runway is less than 9 months, add 1 month of expenses to your liquid reserves this month, then another next month. Treasury bills, money market funds, high-yield savings, earn 4.5% to 5.2% while you build it. The goal is not to get rich. The goal is to buy yourself time. Day 7. Tell one person, not on the internet. Person. Your spouse, your partner, a trusted friend. What you found when you did the audit. Money is the most isolating topic in personal finance. The people who get through these periods with their relationships intact are the ones who talk about it before the crisis makes talking necessary. Closing the title of this video says, America is entering a financial crisis. Get ready. The get ready part is the only part that was ever in your control. A financial crisis is not a weather event. You cannot predict the exact day it will rain. You can only make sure you have an umbrella. Umbrella is not a prediction. It is not a stock pick. It is not a political opinion. The umbrella is 9 months of runway. No variable rate. Debt you cannot pay at the reset rate. A portfolio you understand well enough to hold through a 30% decline without selling. A job that does not depend on the cost of money. A plan that does not require you to be right about the timing. If you have those things, you do not need this video. If you do not, you do not need to panic. You need to start building. So the cost of money will not stay where it is forever. Neither will the economy. So the question is not whether the cycle will turn. So the question is whether you will be ready when it does.